So Akhil, Rishi Sunak finally in charge at number 10 Downing Street. Going back to our last video, you was quite disappointed that it was Liz that got appointed and Rishi was unfortunately didn't make it. But now he's there. What's your thoughts on this?
Well, firstly, thank you and welcome back, Tristan, to the OMB offices here in Bracknell in Berkshire. Yeah, it was unfortunate we didn't have Dishy Rishi in the first place. It meant the market's turmoil. It meant Crazy Quasi's mini budget, also known as explosive budget, coming into play. Interest rates went up and we are where we are today. But unfortunately, it wasn't the right decision first time. But now Dishy Rishi is in charge with Jeremy Hunt as well.
So we'll see what happens. But since his appointment, we did notice some stabilisation in the financial markets. Some predictions from Zoopla and Rightmove also positive, and I can only see it getting better. But what's your opinion on him being in charge? Where do you see the markets going with obviously that moving forward?
Well, I think it's a great combination in terms of Sunak and Hunt. Whether Hunt was Rishi Sunak's first choice and Chancellor, we'll never know, I guess. However, Hunt's remaining as the Chancellor. Sunak was the pre-Chancellor prior to Hunt, which is good to see. So I think from an economics perspective, well, listen, Sunak's got a great CV behind him. He's from the city. He's got a financial institution background. He's worked with major institutions previously in the past. So I think it's a great fit. I think if you're going to run a country, you need to be a businessman first and foremost. You need to understand business economics. You need to understand about fiscal policies, and you need to know about money. So I think we've got the right person in charge. Yes, we're probably going to have some problems. We've already got another problem with Suella Braverman, whether that was the right decision as a Home Secretary, but that's what happened. And I'm sure we're going to have another cheese and wine epidemic going forward as well in the future. But hopefully nothing serious comes out of that. But on a serious note, I think it's a great appointment of having Sunak in charge at number 10. The markets, as you quite rightly said, have taken a great positive outlook on the head of the table at number 10. So it all looks very, very positive at the moment.
I think another thing to note with him being in charge was he made some big changes to the property industry going back when he was Chancellor, i.e. pushing the stamp duty holiday, eat out, help out, as we spoke about in our podcast the other day. I want it back. I don't know if you agree. But also, he also pushed for the Renters Reform Bill, which as it stands is still going through Parliament no later than March next year, which is going to be a big change to the property industry. How do you feel about this?
Well, I think with any change in government and changes in MPs and different relevant seats, you're always going to have winners and losers in all situations. What I think is we've now got a new appointed housing minister in terms of Michael Gove, which I think is a great appointment. I'd rather have him in my cabinet rather than outside my cabinet because he's quite a loud mouth, and I'm quite a big fan of Michael Gove, actually. So I think there's lots of good things that are going to come into play. I think particularly for those properties that are not active at the moment, dilapidated properties such as commercial properties. So I think Michael Gove will probably looking at those properties in particular and looking at permitted development rights and what people can do with those properties. Now, England has always got a problem around legacy issue around building homes. So we're supposed to build about 300,000 homes. We're nowhere near that. I think we're building shy of 200,000.
We've never been near it, have we?
I don't think we have, unfortunately, and that probably goes back to councils, Article 4, planning issues, and everything else in between that. So I think property is always going to be one of the main priorities in any government's priority list. I think what we have to do now is give this government some time to look at, Rishi Sunak and co have got a massive in tray at the moment. They've got to look at inflation, cost of living, the coming out of Brexit, housing, inflation, and everything else in between. So there's lots for him to do. I think it's just prioritising 1, 2, and 3 what they need to do. Key one is cost of living. Second is probably inflation, and the third is probably the interest rates. So they're the top 3 to do, and then everything else will come into line. Surely sooner rather than later, I should say. But I think, as you right said, there's lots of changes around Section 21, permitted development. I think we've got the Help to Buy ending in March. I still think there's going to be a couple of more incentives coming into play. Yes, interest rates are on the up, and I think that's probably going to be one of your questions later on, I'm sure. But there's opportunities for everyone. House prices coming down, we might see a correction. It might help a first-time buyer come onto the ladder. So, hopefully we'll talk about that shortly.
Every market makes a market. Someone told me on a podcast, and I think that's a great way to explain it.
No, I totally agree. There's always an opportunity, and when people are, I think Warren Buffett said, when people are fearful, you should be more greedy, and vice versa as well. So, there's always an opportunity, but again, you've got to surround yourself with the right people.
So Bank of England have increased base rate to 3% from
Yes.
2.25%,
Yeah.
which is one of the biggest increases, single day increases in many years.
Yeah.
But what impact is this going to have to us or any investors out there looking to buy, and what does this mean for us in general?
Well, what does it mean? So yes, you're quite rightly said, this is the biggest increase we've had in over 3 decades. And for people that have bought properties in this generation, they've never seen a rate increase. They've been, sub 1% for a long, long time now. But nothing can stay at rock bottom. Whatever goes up must come down, and what goes down must come up eventually as well. So I think the days of 1%, 2%, and 3% are now behind us, unfortunately. We wanted them to continue forever, but nothing's forever in life. Yes, we've had a rate change. It's gone from 2.25 to 3% as of yesterday. Was it the right thing to do? I think yes. I think the reason why Bank of England have had to increase the rate so frequently at the moment and so with larger increases, just simply because they've delayed the increasing of interest rates, what they should have done about last year or the year before, but because of the pandemic, they had to be pushed back. So the reason for the bullish increase in rates is simply because they have to try to combat inflation. Cost of living is spiraling, and so are inflation. Bank of England's inflation rate at the moment is 10.1. I actually believe it to be about 20%. I've been saying this for months. People are now talking about recession. I think we've been in recession for about 6 to 9 months, to be honest with you. But we're looking at mainstream media, and they're now pointing in direction of a light-hearted recession. There's no such thing as a light-hearted recession. We're either in a recession or not in a recession. So I think whether you're a property entrepreneur, buy-to-let landlord, or even a homeowner with a family, you've got to take this very, very seriously. What does the interest rates mean, the increase in interest rates? Well, it doesn't mean much to most of the general public, but simply because most of the public are in fixed rate mortgages anyway. So if you're in a fixed rate mortgage and your mortgage is not coming up for another year or 2 or 3 years, there is no change to your monthly direct debit, which is good news. But however, those of you that are listeners and viewers on your channel that are on standard variable rates or on tracker rates or even on discounted rates, they may see, and they probably will see, a change in their monthly direct debit going forward each and every month, simply because the rate changes are taken into effect. So if somebody's paying £1,000, that might now jump to a couple of extra £100 because of the rate changes. So you've got to be very, very close to the numbers, understanding when your mortgages are coming up. And it's frightening to see people are still on standard variable rates that we speak to on a daily basis. I've been on my standard variable rate for the last couple of years. And they probably have been, and they had no reason to change because they haven't seen any changes in their rate because the mortgage rates haven't changed. But now that they've seen mortgages rates going up, the payments are now going up as well. So stay very close to your numbers. Contact your mortgage brokers up to 12 months prior to your mortgage coming up. Most lenders allow you to refinance product transfer within 6 months of your expiry date. So now's a good time to start taking this more seriously and looking at the numbers.
Who are you typically seeing on the variable rates at the moment then? Is it someone that was just taking advantage of low rates previously where they had a plan to maybe flip it, or is it just someone that just couldn't be bothered to change it over thereafter and just kept it on there? What are you typically seeing?
I think there's loads of reasons. One, it could be complacency. It could be I'm too busy, it's not urgent for me, it's non-priority for me, so I've left it. It's working, I've still got good enough surplus income, it's making me a tidy profit, I don't need to worry about it. Sometimes it could be a question of I'm in two minds whether I'm going to sell this property or I'm going to keep this property. So by staying on a variable rate, it means that I can sell the property and I've got no early redemption fees to pay to the bank, so I might be in two minds. The other thing is I totally forgot about that mortgage. I didn't know it was up. I misplaced the letter. I didn't receive any notification from the bank. My mortgage broker didn't contact me, etc., etc. So there's loads of reasons why, but I think what's happening now is because the mortgage market is in the news every other hour on BBC News, Sky News and everything else, it's hard to avoid those sort of conversations. People are talking about it down the pub, in restaurants and our offices. So it's hard to avoid those conversations. It's hard to forget about mortgage changes. So it's probably a good thing that it's out there in the open media and people are talking about it, because it gets people start thinking about, taking this more seriously and then planning for the future rather than becoming reactive, becoming more proactive, I would say.
So let's talk about fixed term then. I've seen a number of articles going up, coming down. No one really knows what's happening. And obviously since then we've had a base rate increase. So what are we seeing today with rates? and where do you see it going moving forward?
Good question. The market is now steadied. Lenders have now come back into the market offering fixed rate mortgages. Usually lenders offer a 2 and a 5 year fixed rate option. Some lenders are now offering 1, 3, 7 and beyond fixed rate mortgages. But let's concentrate on the 2 and 5 year rates because they're simply the most talked about and the most taken up rates. 5 year options are widely available now. The rates have gone up. What I would say is the 2 year rates at the moment are slightly higher than the 5 year fixed rate. And that simply means is the market's calculating and they are factoring in over the next couple of years there's going to be a bit of volatility around house prices, around interest rates and fixed rate mortgages. So what they're trying to say is there are 2 year rate options available, but you might have to pay a premium for that borrowing because the cost of funding for that duration is a bit more expensive simply because of the volatility in the market. If you wanted to apply for a 5 year fixed rate mortgages, they are available. The price actually slightly lower in some instances, which means the lenders are taking a view that the short term is going to be a bit of volatility, but we're going to be back to a good, prosperous property market going forward in year 4, 5, 6 and beyond. So that's good from that perspective. Your question around lenders offering lower rates. There are many, many lenders at the moment reducing their rates since the change of government, since the stabilisation in the money markets and the Bank of England's rate decision yesterday. Now, our phones, our laptops, our PCs blow up on emails every day with lender changing in rates. Now, what I would say is in the last 24 hours, we haven't had many emails from lenders to say we're increasing our rates, we're reducing our rates. And that's simply because lenders factored in the rate changes which were guaranteed that were going to happen yesterday in November. And I think I did predict in our last video we're going to see a 0.75 increase, which did actually happen. So they actually factored in a rate rise. They also factored in a 0.75 increase in rate. Hence why we haven't had volatility in the fixed rate mortgages with lenders pulling rates, reducing rates, or even increasing rates in the last 24 hours. So that's a positive news. So that shows that the markets are more consistent, more confident in the housing market, and there's not much volatility, and hopefully that may that continue going forward. And I do believe now going forward we will see more stability around the fixed rate mortgages, albeit that unfortunately those rates of 1, 2 and 3% are now long behind us now, and we're going to see the days of 3, 4, 5, 6% rates now for the foreseeable future.
So talking about the 2 and 5 year fixed, you mentioned it's slightly more expensive for the 2 year fixed as opposed to the 5 year. Are we talking a couple of percent? Are we talking less than percent as it stands, or what are we seeing?
Yeah, no, it's certainly less than 1%, the changes. It's usually 10 or 20, 30%, 30 basis points, which means 0.1, 0.2 or 0.3%. Every little helps, but what I would say is very marginal at the moment. Usually it should be a lot more bigger, the gap, but that just shows that the market is factoring in a positive outlook in the sort of medium to long term UK housing market.
So if you want to secure a lower rate for a 5 year fix without having to worry about potentially going up, down or not knowing what's going on, then potentially the 5 years sounds like the better option for less than 1%.
Yeah.
If it was a £200, £300, £400 increase a month, then it might be a different option you may want to consider.
Yeah, there's lots of, it's a good question. There's lots of things to consider whether you're going for a 2 or 5 year fix. Now, we have these questions all the time. In the buy-to-let space, the biggest factor is the rental calculation. And it might be a question that we might want to go through a bit later on, but if you borrow on a 5 year fixed rate mortgage, you're allowed to borrow a bit more because the calculation and the stress test is a bit more lenient. If you're looking to sell that property, for example, in the next 2 years, you're in two minds that you might want to apply for a 2 year fix. However, the stress test might be slightly higher, therefore you're unable to borrow the desirable amount that you wanted to borrow. So there's lots of factors to consider whether you're going for a 2 or 5 year fix. 5 year just gives you, 5 or a 2 year just gives you more comfort, and it gives you that stability of what your payments look like for 24 months or 60 months.
So how does stress testing work at the moment then? So with the base rate increase, obviously rates going up, have there been any changes on this for a buy-to-let, or are we going to see any stricter requirements in place in order to get a buy-to-let mortgage? Can you give more information on this?
Yeah, it's a good question. I'm glad that you touched on stress testing because it is a hot topic at the moment, and it's a conversation that we're having with all our buy-to-let landlords when they're coming to either purchase or even refinancing. So historically, and I say historically, which is like a couple of months ago, stress testing was quite pro landlords in terms of here's my rent, here's the calculation, and you're able to usually borrow up to 75%. usually if you're borrowing in a limited company capacity or a 5-year fixed. However, the new stress test model, because of the high interest rates and the SVR rates, lenders are now factoring in higher interest rates because their margins have gone up. The Bank of England rate's gone up as well. Where lenders were stress testing at usually pay rate, which was in the limited company space about 3.5%, they're now, if you look at 5-year fixed rate mortgages, are typically around 6% now. They're now factoring stress tests at 6%, if not 7.5. So where the stress tests were at pay rate at 3.5, now they're at 6.5 or 7.5. That in turn means the amount of money you can borrow now is a lot more lower. And I think we've done videos in the past around stress test calculations and how much you're able to borrow. So your viewers might want to, look back at the catalogue and looking at those videos. So unfortunately, where that £1,000 a month usually could have got you a mortgage for 172,000, it now might mean you can only get a mortgage of 152,000, which in turn means you need to then find 20,000 more deposit for that new purchase. Or if it's a refinance, you've got two options. You can either usually do a product transfer with that same lender. So that means a like-for-like mortgage transfer, same debt, same lender, just a different rate, but unable to borrow more money. Or if you're looking to refinance to a new lender, we can still look at whether that rental calculation allows you to borrow a bit more with a new lender based on their stress test calculation or not. Again, it's horses for courses. The key here is to speak to an independent mortgage broker that understands the whole of the market, understands stress tests across the entire buy-to-let lender range, and also looking at your background portfolio, because not every lender stress tests the portfolio in the background. Some are just concerned about the security itself.
So would top slicing be considered in these circumstances?
No, you're right. Top slicing is it's a great tool that lenders have applied to the mortgage market, and that simply means that if you're short of the rental to get X amount loan amount, you can use your income in the background to top that loan up. So if you're short by 20,000 but you've got income of X, they will then apply that surplus income on that buy-to-let stress test, will then allow you to borrow the extra amount that's required. There's about, give or take, about a dozen lenders in the market that now offer top slicing. And I think it's another thing that lenders are putting their time and efforts into creating more creative products, because they're going to have to do something about it, because what's going to happen is this could be another mortgage prisoners. And we've got, with cladding issues and various other issues in the market, where you could become a mortgage prisoner with a single lender because the stress test doesn't wash with other lenders out there, which means that you might be on a slightly higher rate than you could have if you remortgaged elsewhere if the stress tests work. So be mindful of, when you're coming off these deals, does your stress test work enable you to get onto a competitive rate with a competitive lender? Or are you then a mortgage prisoner with that lender and then you're stuck with whatever products they can offer you? So yeah, do bear that in mind.
So let's talk predictions, Akhil. Last time we met, you predicted a 0.75 increase, so hats off to you, well done.
Yeah.
What do we see moving forward? Are we going to see another increase? What's your predictions?
I'm going to keep doing this because it's definitely a yes, unfortunately. And I wish I could say no, but unfortunately it's a yes. I look like the Churchill dog there, didn't I? Yes, we're going to see another increase. I think the next time the governor of Bank of England and his crew get together is December the 15th. They're probably in talks already. They've probably already made their minds up. We saw a 0.75 increase in November. I don't think it's going to be as bullish as that in December. I think they're going to give us a Christmas present. However, it doesn't mean zero. I think it'll be 0.5%. So I think an increase of 0.5%, which means by the time we're eating our turkeys, chickens and lambs for Christmas dinner, it will be at 3.5%, I believe, of 2022. I think the key here is to understand, listen, we're going to see rate increases every month going forward. I think we need to look at the end game for the economy and where are rates going to head to and stay at. And I say that because I like to stay close to the numbers. I think if you're in business, you're a property entrepreneur, you need to be very close to the numbers and understand where we're heading to, why we're heading there, and how long it's going to remain there for. So your question is, what's my guess? I think we're going to be at 0.5% increase in December, 3.5% for Christmas dinner time. I think the Bank of England will cap the base rate at about 5% going forward. When will that happen? Your viewers are probably asking. I think by 2024, So December 2024, I think we'll be at 5%. The governor mentioned yesterday, I think they said they're going to peak at 5.25. The key here is the indicator is how inflation gets combated. We're at 10.1 now, officially on paper. I think if we see that coming down in small increments, that means the less bullish the increases will be. But I think the Bank of England have said that base rate's going to remain at 5% going forward for the foreseeable future. And what I mean by foreseeable future is for the next 10 years, base rate will be at 5%, which in turn means fixed rates are going to be 5.5%, 6%, and 7%. So unfortunately, for those viewers that are hoping for 2% and 3% fixed rates, I wish I could say that that's going to happen. Again, I'm only guessing, and my guess is only as good as my own guess. There is no advice from this perspective at this time, but I think base rates heading to 5%, which means in turn our fixed rates are going to be 5%, 6%, and 7% for mortgages. I can't see them coming down anytime soon, but we're going to see small increment changes over the next 12 to 18 months.
So we'll see over the next few months then if you are correct about a monthly increase, and we'll also see if it goes to 3.5 as you also said.
Yeah.
Last month's prediction was right. Let's see
Two out of two, hopefully.
if you get 2 out of 2. So moving on then, finish off the monthly update with some top advice.
Yeah.
So anyone looking to invest in a property out there as it stands today, or an existing landlord maybe looking to refinance or to invest in another property, what's the best or top advice you can give based upon the markets as it stands today?
Perfect. If you're a buy-to-let investor, your priority and your top priority, I should say, is surplus income, cash flowing investment properties. Don't worry about capital growth. Look at cash flowing properties. And what I mean by cash flowing properties is it covers the mortgage costs, it covers any voids, it covers the maintenance, and it covers your agent fees. As long as it covers those and it's providing a positive cash flow each and every month, that's a great asset. Bear in mind the stress tests that are happening in the background. Anything sub 150,000 purchase price usually will wash its face on a 75-80% stress test calculation. Get in touch with us and we'll go through the rental calculation with the investor. The other thing is to bear in mind, if anybody's coming off fixed rate mortgages, another top tip is anything coming up in the next 12 months, contact your mortgage broker to understand what your current lender will offer you, what the options look like, and does the stress test, bearing in mind how much you've got outstanding, allow you to move on to a new lender on a competitive rate. The third one I want to give you as a top tip will simply be start talking to your power team, your solicitors, your accountants, your estate agents, and your mortgage brokers. There's always 4 pivotal people in this business that you need to remain very, very closely to. And if you are still in the market for investment properties, speak to your local agents, explain to them exactly what properties that you want to buy, the types of properties you want to buy, and tell them who your mortgage broker is, tell them who your solicitor is, because what they want to know is that you're a serious buyer, you've got proof of deposit, and you've got the capabilities of applying for a mortgage. And that's where we come into play, and we'll speak to your estate agent, give them the comfort that the decision in principle is available, the stress tests work, this is the price range that our clients are looking for, and we're good to go. So they're my 3 top tips for any buy-to-let investor, and that's in any market, but more so is if your mortgages are coming up, just be wary. Unfortunately, you're going to get a bit of an eye-watering rate on the exiting of those rates. It is what it is. You're either going to sell, you're either going to refinance, or you're going to be in between. You can't be in between, I should say. So you're either going to sell or you're going to refinance. But don't just think buy-to-let is dead. It's simply not dead, because we are still very, very busy in that market space. We help clients on the buy-to-let space. We also help clients as first-time buyers or home movers as well. But from a buy-to-let perspective, it's certainly not dead, the buy-to-let market. It might just mean a bit more creative investment analysis on how you buy those properties. And it might now mean that if you've got a single buy-to-let and it's let to a family and it doesn't work on the stress test, have you thought about converting that 3-bed house to a HMO to increase the yield, which therefore means you're able to borrow more because the rental income's gone up? Just another top tip from me.
So there it is, Akhil's top tips. And as usual, if you've got any questions at all, reach out to myself or Akhil. Details will be in the description. And until next month, Akhil.
We'll see you soon, Tristan.